interventions have materially, substantially, or in a major way made our economic problems worse. I'm going to take the affirmative of that and argue that they have, based on research I've done, other people have done, some here at Stanford. But of course there's disagreement about this topic, and I think one of the important things people should know and try to get an understanding of is why there's disagreement. And I think a debate format like this is a good way to see the counterpoint. So I thank the SIEPR and John and the SIEPR staff especially for putting this on. I thank Larry for joining us here, and I thank you all for coming. Appreciate it. I don't think there's too much question that we do have some economic problems. We had a very serious financial crisis. We had a deep Great Recession, and we now have a recovery which by all accounts is very slow and weak. It's good that growth is picking up this year, maybe 2.5% compared to where it was last year at 1.5%. But basically this 2.5% recovery since it began 10 quarters ago, since the recession ended, is weak by just any reasonable standards. I like to compare it with the recovery from the early 80s recessions, 83, 84, those 10 quarters. At that point, growth was 6% per year. And this low growth, 2.5 compared to 6, is really why unemployment is lingering at high levels. It's why long-term unemployment remains very high. It's why job creation has been so weak. And so these are serious problems facing people in the economy and facing the economy as a whole. I also think we need to think about some more specific things, such as the debt. The debt is growing very rapidly. It itself is a risk. It's a risk for us. It's a risk for future generations. I lecture the Economics 1 in this lecture hall. It's a beautiful lecture hall. I like to bring my baby grandchildren in to help me with the lectures, to illustrate the burden on future generations. At about 1 year old or so, they don't speak a lot, but they really get the message out, and that is we got to fix this. So my view here is that in that sense, there's some good news, because if you believe me that the ultimate problems here are policy related, it really suggests that change in policy will fix them. So let me kind of tick off the ways in which I think the interventionist approach has really made things worse. Let's start with monetary policy, actually. Monetary policy, the Federal Reserve intervened compared to what it did in much of the 80s and 90s by holding interest rates very low in 2003, 4, and 5. Those very low interest rates stimulated risk-taking, created more of a boom in the housing market, which ultimately collapsed with a lot of bad debt and a lot of bad loans, which was really one of the big parts of the financial crisis. So again, that was an intervention or a deviation from the current policies that we saw were working well over periods. Second would be what I would call an intervention or deviation from good rules-based policy amongst financial regulators. We saw regulators, whether it's the financial banks, the commercial banks, or whether it's Fannie Mae or Freddie Mac, deviate from sound rules which are on the books for various reasons. With hundreds of regulators on the major New York banks on their facilities, really there was a deviation from what I would say good policy at that point. So it wasn't that it was too little regulation, it was really the regulations were not enforced. As this kind of interventionist approach continued as the crisis developed, I call it the on-again, off-again interventions, the bailouts of some firms and not others, not a very coherent policy. And yes, some bailouts worked, some bailouts helped. The commercial paper market, for example. But by and large, that series of highly interventionist bailout policy, largely by the Federal Reserve, I think really made the crisis worse. We now are continuing to see these interventions by the Federal Reserve. We have quantitative easing 1 and quantitative easing 2. These are big purchases, whether it's mortgage-backed securities or treasuries. I think a lot of those have not had much effect. Some research I've done here at Stanford with Johannes Strobel has showed that. But the main thing is they cause uncertainty and unpredictability about policy. We now have pledges that interest rates are going to stay zero through 2014 in an environment where many indicators are saying we should be thinking about raising rates already. Let me go back to some regulatory interventions. We now have got this massive regulatory reform bill, Dodd-Frank. It was put together to try to prevent financial crises. I think it's quite likely going to make them worse. We set up a facility, ordered liquidation authority, through which the FDIC can go in and intervene and effectively bail out a financial firm. We also have hundreds of regulations. Believe it or not, there are 200 regulations that the Federal Reserve and other regulatory agencies have to write rules about. They usually write about 10, maybe a year, 5, 10 a year. They've got 200 to do. Each one of those is going to be hundreds of pages. One of them was a so-called Volcker rule, 300 pages to describe one little rule about proprietary trading. So there's a lot of uncertainty about the implications of this, which I think are very clear, and people have written about it quite a lot. Let's talk about fiscal policy briefly. I think fiscal policy is another area where the attempt to intervene has made things worse. It certainly hasn't improved. I've done a lot of research on this with my colleague here, John Kogan, and others. What we have done is look carefully at how these, whether it's a stimulus package in 2009 or cash for clunkers or first-time home buyers, or whether it's even the stimulus package in 2008 or even earlier, we haven't been able to find any significant impact. In fact, I think the unpredictability caused by these discretionary actions, these short-term discretionary actions, has been negative. Another one of our colleagues here, Nick Bloom, along with Scott Baker, has actually shown you can measure some of this unpredictability or uncertainty about policy, and it is a drag on growth quantitatively. You remove some of that, you can create a couple and a half million jobs. So that's a serious thing. Now, when economists sort of talk about fiscal policy, talk about it in this lecture room to undergraduates, you talk about how fiscal policy can be helpful. If there's a drop in aggregate demand, you increase government purchases, and it offsets that. It's a multiplier effect that kind of gets the economy going. When you look at how this gets translated into the models that are estimated the data, you see huge differences of opinion. Sometimes it's a big effect. Sometimes it's a small effect. I generally tend to find smaller effects. But the point is the models disagree. So you can't use models alone to evaluate whether these kinds of interventions work. You have to look at what actually happened, where the money went. That's what John Kogan and I tried to do. So, for example, some of the stimulus packages which sent money to people, you can see their income went up as the money went out. Big blip goes down. You see almost no impact on consumption. And that's basically what we should have known from the past, permanent income theory. Very little effect. If you look at the government purchases part of this idea, again, government purchases try to stimulate the economy. Well, it turns out at the federal level, there's been very little increase in purchases. 0.05% of GDP is infrastructure. And then if you look at the money that was sent to the states, we can't find an impact on government purchases. Most of the money seems to have been gone to purchasing of financial assets, which is not stimulative. So I can go on and on like this, but I think you're getting the message. And one of the most amazing, maybe distressing things about this message is that we have lots of historical evidence along these lines. In the late 60s and 70s, there was also a lot of this interventionist, whether fiscal policy or monetary policy. President Ford had a stimulus package. I worked on his Council of Economic Advisors. We wrote a report after that saying it didn't work, don't do this again. President Carter came in and he did it. His advisors later wrote it didn't work. By the end of the 70s, Tom Sargent, Bob Lucas, who would later win Nobel Prizes, were saying this stuff doesn't work. After Keynesian macroeconomics, they called it. So we stopped for other reasons. And that stopping actually, I think, improved things. The 80s and 90s worked pretty well. We had long expansions. Unemployment came down, inflation came down. And the tragedy, in a sense, of all this is that the last few years have forced us to relearn what we should have known 30 years ago with enormous pain to people in the economy. Thank you.
I am grateful for the invitation to participate in this debate, especially in the presence of my Aunt Selma, especially in the presence of a statesman like George Shultz, who is an example to John and I and to many others who have served in government. I agree that this kind of dialogue is probably more illuminating if slightly more tension-provoking, than speaking only with those with whom one agrees. John said several things that I agree with. He said that all is not well in the economy right now, that we've got a long way to go to recovery, and I agree with that judgment. He suggested that economic policy choices were overwhelmingly important for economic outcomes, and that the choices the government makes are very important. And I agree with that judgment as well. However, I disagree with him on the broad resolution that we are asked to discuss. His thesis is that if we had had less government action, we would have had less of a financial crisis. That government regulation to protect against financial crises, in fact, makes crises more likely, and that government's efforts to respond to this crisis have in fact exacerbated the crisis. And on all three of those points, I profoundly disagree. The roots of this crisis lie not in the stars. They lie heavily in the failure of government to regulate financial markets with adequate vigor. The most embarrassing photo op in modern American political history, I would suggest, is the photo op of major financial regulatory officials, essentially all of those in office in the early 2000s, standing with power saws and garden pruning shears and taking them to the regulatory books. That was the stated objective of public policy in that period, and it had predictable results. State attorney generals who wished to stop predatory lending were prohibited from doing so, contributing significantly to the excessive lending that led to the housing bubble. Those who wished to regulate the capital of investment banks were prevented from doing so. The stated objective of financial regulatory policy was to win a race to the bottom in terms of minimal regulation with London. That race was won. And we saw the consequences of laissez-faire financial markets. We saw it in the profound instability associated with the housing bubble, to which there was no public policy response. We saw it in the excessive leverage at major financial institutions, whose failure or prospective failure then did enormous damage to the economy and called forth the necessity for substantial payoffs. One of the great lessons of financial life, I would suggest, is what I have called the doctrine of huff and puff and pay. It has been my experience that those who give the most powerful moral hazard speeches find themselves the author of the largest bailouts. That's one way of understanding what's happened in Europe. The Germans gave great moral hazard speeches, and now they are authoring the biggest bailouts in history. When the Clinton administration left office at the end of 2000, the new Secretary of the Treasury gave powerful speeches about how the IMF programs of the Clinton era were calamitous in their moral hazard consequences, and in the process managed to bring confidence to a place where within his first 9 months in office, the two largest bailouts in IMF history had to be authored with U.S. support. Creating a sense that there will be no response to crisis while at the same time allowing leverage to reach unprecedented levels, is a prescription for financial accident, and financial accident is what we had. So first, it was lack of government action rather than government action that caused the problem. Second, does anyone believe that in the face of the situation that the American economy had worked itself to in the fall of 2008, where General Electric was not able to borrow money for a week, that the government's announcement that we should rely on free market principles would have constituted an adequate response? Or does one believe that in the face of the vicious cycles of a collapsing financial system leading to rising panic, leading to more withdrawals, leading to more panic, that it was necessary for governments to take strong action? If you look at the first 3 months, the first 6 months after the fall of 2008, they are worse, clearly worse on almost every indicator than the first 6 months after 1929. I believe the fact that government took a set of strong actions contributed to the fact that we didn't get an outcome as bad as it was that is anything like the 1929 outcome. I will leave the question of monetary policy to John, where he is an expert. I don't think the question of whether the Fed was wise or was unwise during the noughts bears on the question of whether government caused our problems. The Fed's job is to set monetary policy, and it may or may not have done the right job. But I will speak to the question of fiscal policy in the wake of the crisis. All you have to do is look at some basic facts. Look at states that got more fiscal benefit versus states that got less. Look at countries that engaged in larger fiscal stimulus programs versus countries that engaged in smaller fiscal programs. Look at the history, as Bob Hall has done, of fiscal expansions associated with military actions. And what you see is that fiscal expansions have a stimulative effect on the economy. Does fiscal policy, expansionary fiscal policy, make sense at normal moments? No, it doesn't, because it's best to use monetary policy to manage inflation and output. Does it make sense in a liquidity trap like the one we found ourselves in, where the interest rate was zero and couldn't be brought down further? I think there's every reason to believe, based not on models, but based on comparisons of where it was applied and where it was not, that it has a beneficial effect on the level of demand. Something turned an American economy that was collapsing. That something was public policies. Is it right to suggest that we can stick with the financial regulatory regime that we had? Is it right that an institution of the scale of AIG should have been essentially completely unregulated? I would suggest not. Dodd-Frank fixes that problem. Is it right that the United States has a financial system where we have a procedure for dealing with a failed bank, but have no procedure at all, other than ad hoc, for dealing with a failed investment bank? I don't think so. Dodd-Frank seeks to fix that problem as well. Is it right that major financial institutions that are not formally treated as banks avoid any regulation of their capital levels? I believe not. Dodd-Frank fixes that problem as well. Does government sometimes do silly things? Of course. Are there regulations that are excessive? Of course. But we have the experience of the 19th century. We have the experience of the early part of the 20th century to teach us how well an economy functions when there is essentially no government and essentially no regulation. And there are not many people who want to go back to that kind of macroeconomic performance. Yes, final thing John said that I agree with is that we do need to think about his grandchildren, and I don't yet have grandchildren, but my grandchildren, when I have them. But part of the way we do that is by having strong and appropriate public policy. And I don't think you can find an example of a successful society without a successfully functioning government taking a role in its economy. Thank you very much.
So we're doing pretty well on time. I'm going to cede just a little bit of my questioning time. We'll give each of them a couple minutes to have some additional thoughts. You can call it rebuttal if you like. John?
Yeah, thank you, John. So Larry, at the end you're saying we need to have a government, we need to have a well-functioning government, we need to have regulation. I agree entirely. No one's trying to say we don't need a government. What I was trying to show, and I think the data are clear on this, is that sometimes government screws up big time. And a lot of it is because they don't follow good economic predictability rules. They intervene and actually make things worse. And so all of my examples are along those lines. I think we agree, I wrote it down, you say the failure of government to regulate markets, financial markets, with sufficient vigor was a problem. That's exactly my second point. Basically, the rules on the books were not enforced. Fannie's regulators, Freddie Mac's regulators didn't enforce what they should have. The Federal Reserve had plenty of power and opportunities to restrict the risk-taking and the leverage ratios at the financial institutions so they regulate. To me, that is a government failure, an intervention of what shouldn't have occurred. Larry mentioned the bailout philosophy, which I think is very destructive. And in the period he referred to, in the 2001-2002 period, there were a couple of bailouts. Effectively, I would call it a transition from an incredibly bailout-oriented mentality that came from the Clinton administration on international, to try to get out of that. Not instantly, that's a bad thing to do, to shake up the markets, but gradually. And after 2003, the IMF changed its rules. They tried to institute some alternatives to bailouts. Collective action clauses were put in government sovereign debt to prevent the bailouts, and in fact the bailouts stopped and emerging markets behaved so much better. What's one of the reasons why the story is a trading place is emerging markets have behaved much better than in the 90s as we've reformed much worse. One of the most difficult things to debate and to really study is the things could have been worse idea, which Larry mentions. Things could have been worse. It is so hard to run through a situation, counterfactual at this point. But what I stress is that, of course, there were some interventions that helped. Commercial paper market, for example. But if you look at the whole wide, long series of interventions, we wouldn't have had to do those interventions if we hadn't caused the damage in the first place. So, of course, some interventions work. But the whole series is what's caused the problems, the unpredictability associated with that. And just one last thing, on the Federal Reserve, I think there's a pretty good theory about how monetary policy should work. It worked pretty well in the 80s and 90s until recently. And I view the deviation from that policy for purposes, for whatever the reason was, obviously trying to do better. But that was an unintended consequence of an intervention. I think it's just as damaging as whether it's the interventions from good regulatory policy or the interventions of a discretionary fiscal policy. I think it's very important. That's why I started with that. And so we don't want to just discount that. Thank you.
You got it going. Larry, want to say a word or two?
Look, on financial regulation, it sounds like we agree that there wasn't enough financial regulation before the crisis, that allowed the financial system to get out of control, and that contributed to the crisis. We may disagree on how much of that was due to problems with the laws and how much of that was due to problems with the regulators, but we agree on that, and I at least would interpret that as evidence that we needed more government rather than less government. On bailouts, we can discuss this later, John. I think you're working it. The Secretary of the Treasury stood up and proclaimed repeatedly against the advice of those who were going out of office, invested the credibility of his office in the statement that the United States would never support another large bailout of the kind the Clinton administration engaged in. The consequence was to create substantial alarm and panic with respect to a number of emerging markets, which created a situation where there then needed to be much larger bailouts than had taken place previously. I think an approach that was more recognizing of the need for institutions like the IMF to stabilize financial markets, albeit with an awareness of debt, but an approach that was more sympathetic to government, would have been more effective. Look, on monetary policy, I have enormous respect for the Taylor rule, but it is not yet the law of the land. And so to call the failure to follow the Taylor rule an argument that the government is somehow acting excessively and being the cause of the problem. I mean, yes, I think governments should act more wisely in their macroeconomic policies. I think we probably can agree on that proposition, and I'm not choosing to argue with you on the proposition that the Taylor rule would have represented more wise monetary policy at some point. Where I think you do need to recognize it, look, are there things that were done in the wake of the crisis that, with the benefit of hindsight, you would do differently? Of course. Battlefield medicine is never perfect. But if you ask yourself, was an activist government responding to a market where GE couldn't borrow money for 1 week, was the right policy to have an active government in the face of that? Or was the right policy to have less government? I don't see how you can come down on any side other than, thank God we had an activist government.
Okay, so I'm going to ask, as I said, about 4 questions. And John, in your Harvard debate, and John put his Harvard debate up on his blog, Economics One blog, he said something, and he actually says a very similar thing today. He said, you learn virtually nothing if you use the same model to evaluate the impact that you use to predict the impact. He basically said, I just want to look at what happened. And it seems, and today you said something very similar, and you tried to avoid getting into the counterfactual, but it strikes me that what you have to do is you look at what happened and compare it to what would have happened if the policies that you're advocating would have been followed. So it seems like you have to have a counterfactual. I think you suggest that if the government had done less stimulus, things would have been better, but it seems to me you have to have a model to come to that conclusion.
Absolutely, you have to have a framework, and so the framework that we've used is basically a framework that I just described as the Keynesian framework that we teach a lot of students. You have to have some framework. I may not agree with that, but that's the framework. But even within that framework, there's a huge amount of difference of opinion about how big the effects are. I get very small effects, other people get big effects. And so therefore, you just cannot rely on those coefficients on that particular model. So you have to actually then see what would have happened if policy had been different within that framework. And that's what we do. So for example, you can see the payments to people and the rebates, big time goes up and down, and consumption doesn't change. Or, I think even more telling, you can look at where the money went, say in the 2009 stimulus package. You can trace where it went. The theory says government purchases will raise GDP through a multiplier. But when you look at what happened, government purchases didn't rise as a result of the stimulus package. It basically were grants to the states or grants to individuals, and they largely saved the money. So just on the same terminology or the same basis that the theory is that we talk about, it did not work.
So let me just ask a question. This will be for Larry, but Larry believes, I think you believe, that if we had pursued fewer or smaller stimulus packages, things would have been worse. and maybe things would have been better and we'd done more ambitious things. So you get exactly the opposite conclusion that John gets. Now, is this an indictment of economics, that there are ranges of models and some support your views and some support John's views, and we just don't know? Or what would you say to that?
Look, these subjects are difficult enough that anyone who speaks with absolute certitude is making a mistake. I think that I like to look for comparisons that are instructive. That's why I look at states where there was significant fiscal stimulus versus states where there wasn't fiscal stimulus and compare their economic record. And that's now been done by half a dozen people, almost universally with the conclusion that the states that got more had larger impacts on GDP. That's why I look at the international experience. Some countries adopted John's philosophy, some countries adopted my philosophy. There's a pretty clear correlation between the ones that did more fiscal stimulus and the ones that had less. That's why you look for other experiments, as Paul and many others have done in their work, looking at moments when international considerations forced the country to have an increase in spending on the military, and looked at what the impact of those things were on the GDP. So I think there are a variety of kinds of experiments that you can look at to test what these alternative ideas are showing. But look, there are questions. John asserts that you had a moment when people were getting a lot of tax cuts, and the consumption didn't go up. That's true. It was also a moment when the stock market was collapsing and uncertainty was rising. And so if you fit a relationship to consumption, in fact, you find that consumption was significantly greater. That would be my reading of the statistical evidence. There would be other readings of the statistical evidence that would be different. So I don't think we can regard the data as conclusive on that point. A place where John and I really have radically different readings of the evidence is the federal government gave several $100 billion to strapped states in 2009 and 2010. I think the evidence is really very clear that the largest part of that money got spent rather than simply getting socked away in rainy day funds and the like. John disagrees. That's a place where we would read the statistical evidence quite differently, and I think that would be a place where there would be divided opinion, but whereas on the question of the impact of taxes, the tax cuts and how much of that got spent, you could find lots of economists on both sides. I think on the question of whether the money to states got spent by states, I think most economists will come down on my side, though certainly not all.
Wait, let's go on. I've got, that's only my first question. I asked each of them. My second question actually refers to some similar items. Given my background, it's not surprising I'm going to emphasize fiscal policy. And I do remember in 2008, the Bush administration had a $300 tax rebate, and there was an expression that this was going to inoculate the economy from a recession. And so just on the basic facts, that inoculation doesn't seem to have worked. And then in 2009, with the Obama administration, the Social Security recipients were given bonus $250 checks. And I don't know whether that's viewed to have worked wonders or not. It doesn't seem to have. But what I wanted to get to is that we just passed a policy in February which seems mighty similar. It was, Congress is great at making up titles, the Middle Class Tax Relief and Job Creation Act, which basically, in my opinion, borrowed $100 billion and lowered the payroll tax by 2 percentage points for 2012. That seems to me very similar to in concept to these $250 checks or $300 checks. Was this this a good move? I'm talking about what we did in February.
No, none of these were good moves. And the fact that you're mentioning something that occurred in 2008 is important because this is not a partisan issue. Both parties. President Ford, I gave an example. We tried this, it didn't work. We know these things don't work, and we keep trying them. And you just gave them the most recent one, a 2-month extension of the payroll tax. I mean, we've lost our collective minds if we think that is a way to stimulate economic growth.
Larry, what do you think about this recent payroll tax reduction? Is that a
I'm
good?
glad we did it. I think if we had not, I think the American economy came very close to recession in the summer of 2011. I think it was a close run thing. I think if we had not been putting close to $1,000 in the hands of each family, there would have been somewhat less spending, and the risks that the economy would have tipped over into recession would have been greater. The people in this room, I suspect that if you give almost everybody in this room, except perhaps some of the undergraduates, an extra $1,000, it would have no effect, very small effect on what they're spending. Temporarily, it would have a very small effect on what their spending would be. But that is not the situation of the vast majority of our fellow Americans. People getting unemployment insurance, Social Security recipients who, and the evidence is, folks, that this happens not infrequently, take their pills every other day because they can't afford to take them every day. You think people like that save the money when they get given a rebate? I don't think so. So I think the evidence is that it was it the best thing that could have been imagined to do? You can debate that. You can debate that too. But did we have more spending as a consequence at a moment when the economy was very vulnerable? And by the way, if you take the alternative theory that's really advocated here is that people are in debt and used it to repay their debt and to return to a more normal situation after having been excessively in debt. I mean, it's just not, you just look at the evidence of people with incomes of $35,000 to $40,000, they're not accumulating financial assets. They're just not. I mean, they are net debtors. And so if we gave a tax cut, and the consequence of it was that they repaid some of their debts on which they're paying 19% or 22% interest to some credit card company, and we're in a stronger position to spend, I hope they spent it because I think that's better for the economy in the short run. But if some of it was used to pay down debt, that does not make the measure ill-advised.
Okay, so I'm trying to move us along. So this one's going to be, I think, primarily for you, Larry, because John's mentioned this study by Nick Bloom and his co-authors, which says that the level of policy uncertainty is abnormally high today, and he has some evidence that that's holding the economy back. And John seemed to agree with him already, so that's why I thought I'd put the question to you. Are you concerned about the number of tax issues where we've extended them and there's uncertainty whether we'll extend them further? And just the amount of policy uncertainty seems to be very high right now.
I hesitate to speak about Nick Bloom's study when I don't know whether Nick Bloom is in the room or not. But my understanding is, and I'm reasonably confident I'm right, is that it does make a reasonably strong case that uncertainty has an adverse effect on spending. However, the examples of uncertainty, places where they find tremendous uncertainty, are, for example, the week after Lehman, are, for example, when the Europe situation was at a precipice. So there is a case that when people are very uncertain about the future, they tend not to spend. There's no case made that discretionary government policies increase that uncertainty. And I guess the evidence that I would cite on this, John, is if you look right now at the so-called VIX. The VIX is a measure of the volatility of the stock market as people expect it to be in the future. So if you thought there was tremendous uncertainty and anything could happen, you'd think that we would have a particularly high level of the VIX right now. And what stands out is how low the VIX is. And the only thing that's lower than the VIX is what the recent actual volatility of the stock market has been. So that would tend to suggest that we were doing a good job of maintaining some confidence in the face of an uncertain world. Here we are, we have a world where there's risks in the Middle East, where there's a situation in Europe that, to put it politely, is a bit brittle and fragile, where we have a set of issues in our own economy. And frankly, because we have had a commitment not to do what we did in the 1930s, which is to let it all rip, but to be prepared to respond to problems, what is actually striking is how quickly uncertainty has come down, and we actually have a good measure of market uncertainty that demonstrates that.
So, go ahead, John. If you look at the Bloom et al. Study, you'll see that a big part of the uncertainty is the uncertainty in the tax code. They measure the number of provisions in the tax code that are expiring each year. And it is skyrocketed to the extent that the whole tax code is up for grab at the end of this year. The temporary payroll tax that you so admire is one of the reasons why we don't know what's going to happen with taxes in the future. What we should be doing, and there's an alternative to all this, is to have more permanent changes in the tax code to stop this short-term stuff. At best, maybe it gives a little boost to the economy, but then you still have this very weak recovery, 2.5% growth. It's really not the kind of thing you needed to get the economy going back like it did in the 80s, in the 83, 84. That expansion brought us back rapidly because we didn't try all this stuff. We didn't do all these temporary things. We had a permanent change, whether you like it or not. It was a permanent change in the tax code, and that's the kind of thing that got us going again. That's the historical evidence.
Let me just review the facts for a second. Facts are that we had a large tax cut in 1981, that we waited fully 12 months until we repealed 35% of that tax cut. That's actually what happened. So the idea that we had one, and we then had another tax increase in 1984. And then we had a major tax reform in 1986. So the 80s stand for many things, and if you want to argue that the 80s are a demonstration of the benefits of cutting certain taxes, I think that's a reasonable argument. But to argue that the 80s are a demonstration of the efficacy of stable tax policy, frankly, is absurd.
No, there were no short-run stimulus packages. There was a Kemp-Roth tax cut that was passed, and yes, there were some, but then the 80s.
Wait, I got another question.
These were not Keynesian.
John, I'm in all honesty completely.
You look confused.
I thought your position was that a significantly changing tax code caused uncertainty and that was a problem. So now we've reviewed the 80s and we've seen that we had a significantly and regularly changing tax code. And so now your position is that if the changes in the tax code are associated with the desire to stimulate the economy, they're a problem. But if the changes in the tax code are associated with a desire to take back the excesses of the last tax cut, as took place in 1982 and 1984, then they're not a problem? Then those ones don't create uncertainty? Is that your position?
All of those tax policies were aimed at permanently making the tax system more efficient, lowering marginal rates. 86, that lasted for a long time. That was not just a year type of thing. It lasted a long time. By the way, we need another one now. Maybe we can agree on that.
I think we're going to leave this.
It's actually an interesting question. It's actually an interesting question. I believe, and it sounds like you believe, that the country would do very well, who's ever elected president and whoever the Congress is, to contemplate a substantial structural tax reform.
Absolutely.
To be legislated in the next couple of years. One has to acknowledge, however, that the effect of that would be, over the next year and a half, to significantly increase people's uncertainty about what the tax code was going to be. relative to sticking where we are.
Since the whole tax code is up for grabs anyway, at least it'll be
Okay, so actually, my last question was, I was going to try to get these guys to agree on something. And what I was going to say is, it'd be nice if the future was pinned down a little bit, if we had a structure to deal with these long-run entitlement problems, and we would have been better off if we'd adopted the structure of Bowles-Simpson. What do you think? Would you both agree, if we, not necessarily exactly Bowles-Simpson, but if we knew how we were going to deal with these enormous entitlement programs, that would add a certain stability to where we're headed? What do you think?
I agree. There are a lot of good things in that program, but long reforms, reducing marginal tax rates, trying to deal with some of the entitlements. I think a framework like that, actually I think the budget that Paul Ryan's put out is just fine for that. So you choose what you want. We can debate whether you want this is not a partisan issue, you can debate what kind of policy you want. And I think it shouldn't be partisan, actually, it's good for the country. But I agree very much. If there could be some plan put out which was credible on spending, on entitlements, on tax reform, it would be a great improvement. It's exactly the message that I get from looking at the harm that's caused by all these temporary interventions.
Larry?
Depends what you mean by Bowles-Simpson. If what you mean by Bowles-Simpson is that we need to take steps to address Medicare and Social Security, which Democrats who voted for Bowles-Simpson recognize, and that we need to recognize that in important respects, tax expenditures are expenditures, and that we need to do something about tax expenditures. If that's what's meant by Bowles-Simpson, then I certainly would agree with that. I think that if you look at the defense spending cuts that are contemplated in Bowles-Simpson, it's really a very real question. Many people in my party wouldn't agree with this, but I think it's very debatable whether those are actually feasible defense spending cuts in the current environment. And I think it needs to be recognized that Bowles-Simpson in the tax area is a bit more of a plan to have a plan than it is a plan. That is, it's a statement that if you got rid of all the tax expenditures, you could have very low tax rates without really grappling with the consequences of addressing those tax expenditures. But there are ideas there that I think definitely are very, very constructive.
Okay, so we're going to have a limited amount of time for your questions. I want to kind of check out the field here. What's the hand up? How about right there? You're walking right by somebody with their hand up.
My question is about the current debate about the health care in the Supreme Court, and there's a mandate, and here in California, every driver who wants to have a license is mandated to buy insurance. Just a fact. Why is no one raising to the debate that a mandate to buy insurance for health care is reasonable government policy? Thank you.
Isn't that the debate in the Supreme Court?
I think
the debate in the Supreme Court is whether the federal government can do that. State governments regulate all sorts of insurance. We talk about Massachusetts. The debate in the Supreme Court is whether the federal government has, under the Constitution, the right to do that. And it's a legitimate discussion to be having. I'm glad we're having it. I actually, from a philosophical perspective, going back to the general thing, I think that all the healthcare regulations, not every one, but a large number, are making the healthcare system less competitive, more costly. And it's one of the reasons why we're driving up costs so much. If we could, use the market more, use less central controls, we would be better off. But the Supreme Court issue is not really on the economic merits, it's on the legal issues.
So let's take a question on that, John. I think that the unfettered market in malpractice is producing really bad outcomes. Doctors do too much defensive medicine. People are capriciously awarded. It's the market. The government's not interfering. There's common law torts. People get to bring torts, and doctors have to pay. So I think the government ought to do something to fix that. But that's more regulation. Do you agree?
You say no, I want no government, I want no regulations, I want unfettered, you create these straw men or women, whatever you call it.
Okay, another question. I asked you to make
that is not what.
a single brief question. What do we have? Yeah, over here. Hey, just wait a second. Just a single brief question.
Does the real estate market have to hit bottom before we can have a strong recovery?
So I actually think we could have a strong recovery if we put in place a budget plan that reduces the growing debt in a sensible way, a policy that is clarified what's happening with the financial sector through Dodd-Frank, that has a monetary policy that's not so interventionist, it's more predictable. That's the kind of policy we had in the 80s where the expansion was very good. In fact, it's the kind of policy we've had a lot of expansion. So the logical implication of what I'm saying is the economy can expand. There's always a weak sector in a growing economy. You can always point. In the 80s, we had a terrible trade sector because the dollar was so strong. So I'd say you look at the big picture here and you see these policy changes. And that's why I think it's good news. If you can make these changes, the economy would be much better than it is now.
We have a question to my left, and you're right. Let's see what it is.
Both of you, what's your opinion of the President's Working Group and the activist nature of the President's Working Group as it's addressed throughout the last couple of decades, the volatility in the financial markets?
Let me just say on the housing question, I'll come back to it. I don't think that some new set of housing policies are the central question for the economy right now. My judgment is that at whatever moment the economy starts to have a substantial recovery, you're likely to see a substantial recovery in housing. I think there are a very large number of young people who have moved in with their parents and not formed their own households, who are getting tired of it, who will be, or their parents are getting tired of having it, who will be ready to go out into the housing market as the economy improves. So if by your question is meant, should we have a lot of new housing policies? I think not necessarily. If you ask, how likely is it that we'll observe a strong recovery with a still badly depressed housing market? My guess is those two things are unlikely to get together. The President's Working Group, look, I think at some points it's done better than at others. I think it failed completely during the period running up to the 2008. It didn't succeed in maintaining stability in financial markets. I think that if the President's Working Group had been entirely passive, then the Great Recession would have been a Great Depression once the problems were realized. Could it have done better in certain respects? Yes, no doubt it could. Should the objective of policy now be, if you look at what one should worry about over the next 5 years, 5 to 10 years, a place where John and I really do disagree, is are we worried that over-regulated financial markets will somehow cause us problems over the next decade? Or are we worried that there will still be important gaps in our regulatory system that will cause us problems? I'm right now more worried about the gaps in the regulatory system than I am about the excesses of regulation.
So let me just have an interlude for those of you SIEPR veterans and also compliment our guest, Larry Summers. For those of you who've been attending SIEPR events for a long time, you may remember that in March 2008, before most of the bad things happened, Larry gave a talk here, and it was a pretty gloomy talk, and unfortunately, the gloom was appropriate. So he did see some bad things coming in March. Like 2 weeks later, Bear Stearns went belly up. So congratulations. We do learn with the hopefully you're feeling better now. But we can take another question or two, and then we're going to go to the final statements. Ann, right here. We can get Ann.
I think this is a question more for Professor Taylor. We have out of Stanford something that could be thought of as a regulatory proposal, which is to sharply raised the capital required at banks. And I'm wondering if you think that doing that in some ways could supplant an awful lot of the regulation that worries you in Dodd-Frank and the Volcker rule.
Yes, I think that's a more sensible way to go. There's a lot of arguments for that. I think liquidity ratios as well would help. Remember that Dodd-Frank has so many regulations that have yet to be written, so many rules that have yet to be written. It really would be better if we just halted with the Office of Thrift Supervision having been merged with OCC, leaving things like that alone, which are good, and disbanding all these other micro things like the Volcker rule and replace them with I think, much better increased capital ratio. So that makes sense to me. It's a matter of how much you do it. It would mean less risk-taking. Wouldn't solve all the problems, but it seemed to be a step in the right direction.
We've got more to fear from too little capital than we do from too much. The problem and the challenge is that we don't regulate all financial institutions. We don't regulate money market funds in competition with banks, for example. And that if you place excessive capital regulations on the regulated sector, what you'll get is an entirely safe regulated sector with the vast majority of the activity taking place outside the regulated sector, which will then cause you a large amount of risk. So that's why you have to write rules expanding jurisdiction, and you have to address a set of other issues. We'd all prefer that there was a single magic bullet that we could use, that if we just regulated one thing and left everything else out, it would be okay. I think the world's more complicated than that.
I saw a question here in the second row. We're getting the mic to get to you right now.
We've been talking a lot about essentially human behavior and what influences it, government policy, other factors. To what extent do you think Kaminsky's hypothesis about stability, inevitably leading to instability, impacts this discussion?
I think it's definitely a factor. People get complacent. It may be one of the reasons why you've seen these shifts between policy which is better and policy which is worse. I think we got out of the terrible policy in the 70s because things were so terrible. Maybe the reason we got back to this more interventionist policy is people got complacent. That stability reduced some of the usual restraints government officials have to prevent all the special interests and the demand to do this and the demand to do that all the time. So to the extent that you have a more complacent environment, it brings you back to these policies which don't work so well. And that could be a way to think about it. It's the idea. I think it's why I just look at this history. It's an amazing history. We had interventionist policies, monetary and fiscal in the 70s. It was terrible. I think it was a much more rules-based system in the 80s and 90s. It worked well. Now we're back to this other thing. And so it's very consistent with what you're saying.
I have one more question. You want to say something?
I want to.
Okay, we'll let it.
I think there's one thing you do have to keep in mind here where I think John goes too far for my judgment. Look, if you look at places where there are more oncologists and there are more people practicing oncology, you will, I promise, find that there is more cancer. That's not usually thought of as an argument that oncologists are counterproductive. In the same way, the observation that the government does more intervention in the economy at times when things are bad than it does at times when things are good does not constitute an argument that government intervention is the cause of the problem. We had a collapse in 2008, largely driven by the private economy. That is what calls forth the remarkable set of intervention that we had. We had a set of activities that included a quadrupling of the price of oil in the 1970s that called forth a set of government actions. Were they the right actions? In many cases, they were not the right actions. But I think it's very important to understand that you have more government action because problems are worse, and that it's a real fallacy to simply observe that the government is acting and things are bad and interpret that as evidence that the government is counterproductive.
Okay, we have one last question, and we'll have closing statements.
Okay. This is a question for Professor Summers, and I think you might respond to it with actually that answer. So my question, your debate focused a lot on fiscal policy and bailouts as the two sort of sides, and I want to focus on the bailout side. And my question is, in your view, do these bailouts raise or lower the long-term growth rate of the economy? Because in the short term, I think we can all agree they're very helpful, but as a younger person, I'm looking out 50 years into the future and worrying to the extent that the uncertainty in the bailouts lower things. I'm going to grade that policy maybe a lot differently than somebody who's a lot older. And so my question is, would your grandkids agree that the bailouts and the interventions are a good idea, or would they say it's a bad idea when you lengthen the horizon a longer time?
I think it's a very thoughtful question, and I'd answer it in two ways. The first is that to the extent that we had a Great Depression rather than a Great Recession, there would have been a whole set of consequences that would have lasted a very long time, that would have affected your grandchildren. Not literally your grandchildren, but would have affected people for a very long time. Kids who come out of college in years when the economy is slack are doing worse when they're 45 than kids who come out of college when the economy is strong. R&D spending, which influences the future, is the first thing to go during major recessions. So the first thing to say is that if you avert near-term economic disaster, that has big consequences for what happens in the future. Look at what's happened. Japan didn't manage to solve its problem, and Japan's GDP is now 40% lower than people would have expected it to be right now as of 1990. So in that sense, the short run casts a shadow forward. Is there a risk that you'll have excessive reliance? Yeah, there is. On the other hand, the fact that people probably smoke more in bed than they would if there were no fire departments is not usually treated as an argument against fire departments. And the fact that people drive faster because there are government safety rails is not usually treated as an argument against having government safety rails. And if we've learned anything from financial history, it seems to me that financial markets are prone to panic, and that you need governments that are prepared to respond. That's, after all, why we decided to set up a central bank and a Federal Reserve System in 1913. There's room for debate about how much you should do it, and that's a very reasonable debate. But we did an experiment in this in the United States, and it lasted one day. We let Lehman fail, and we observed what happened, and then we lurched to go back and providing support. Now, you could argue we should have let that experiment run longer. That's an argument. I don't think that's an argument. I don't think that's an experiment that any responsible policymaker would make. And by the way, the principal argument that was made for it was a version of the argument that John keeps making. John said, the argument that the people who let Lehman go made was, well, we had to bail out Bear Stearns because that was sudden. But now we've had 6 months and we've told people that there aren't going to be more bailouts. And so they should have prepared themselves. And so we are in a regime now where we can safely just let things go. Well, we tried that experiment and we saw the results. So do we have to be careful? Absolutely. But looking at it from the point of view, if we had let the recession be the depression, it would have been very unfortunate for your grandchildren.
Okay, so here's the plan. We're going to have closing statements. You can either stay seated or go to the podium, whichever is your preference. We thought we'd do it in the reverse order that we had the opening statements. So Larry, you go first. You got 5 minutes. We're going to run 5 minutes overtime, which isn't too bad as these kind of things go.
Look, maybe it's best to concentrate on some things we agree on at this point. We agree that public policy choices governments make have a very substantial impact on the economy. And it's enormously important that they be made wisely. that it is very desirable for them to be more predictable in an unpredictable world, to make the world more predictable. Those are all, and that institutes like this and debates like this and economic research and part of that process to contribute to more important choices is very, very desirable. Where we have a difference in view is that I tend to think that the world and that the market activity is a very unpredictable thing. And that a government that commits itself to saying, we don't know exactly which way the wind is going to blow, we don't know what's going to happen, but we're going to lean against it. When there's a panic, we're going to try to calm things down. When the economy is declining, we're going to try to stimulate demand. When the economy is overheating, we're going to try to offset it. And we don't know exactly how that's going to happen, but we are going to try to mitigate that. I think that makes the economy more stable. And I think that we had too little government activity of that sort. That's why I don't subscribe to the resolution. I think John feels that the government too often, in the name of trying to offset volatility, becomes itself a source of volatility. And that's a risk, and that's a risk that I'd agree also needs to be guarded against. But as I look at the history, I saw booming and bubbles and too little government in between 2002 and 2008. I saw a crashing that has not been fully reversed. And I don't think that's an argument that we needed less government after 2008. And I think we probably need more government because I think there are more risks of gaps in our system that will lead to more accidents in the future than there are that somehow we'll have too much government and that will create problems. But really, this is not best phrased as should we have government or should we not have government. We all agree we should have government. It's about having better government. But the fact that we can agree on that should not blind us to what really is a disagreement, which is about the extent to which more activist government is desirable. And I would just say one other thing that has been outside this debate, which is there are a different set of issues that we have not discussed at all, which have to do with fairness, which have to do with equality and inequality, and which have to do with the distribution of income. And increasingly, the outcome that is being generated in the marketplace for the distribution of income may well actually correspond to people's productivities. But it is problematic when too much goes to too few. It does have a set of consequences for a society, and if those issues are going to be addressed, it's only going to be through a more active government. A more active government with respect to education, that we probably all agree on. A more active government with respect to progressive taxation, that would be more controversial. A more active government focused on making sure that there's opportunities for everyone. So I don't think the agenda which treats government as a problem may well, in important respects, have been the right agenda when Ronald Reagan proclaimed it in 1980. But I think it is very hard to look at America as it stands today and believe that that is the right agenda for America.
What I've tried to put forth in this debate, which I've enjoyed, thank you very much for participating, Larry, is that we need to have more predictable government policies. The interventionism that we've seen, the discretionary, if you like, less emphasis on rule of law, less emphasis on predictability has been damaging. We very much need to have a government. We need a government to enforce the rule of law. We need a government to provide a decent education to people, which it's failing to do for large segments of our population right now. And it's heavily regulated. A lot of it is provided by government. This income distribution is a problem. That's one of the reasons we're failing to provide a decent education to large segments of our population. It seems to me that's consistent with the general view I've been putting forth. Now, one thing I'd say, there's a very important set of arguments that I've tried to stress, and Larry has challenged them to some extent, although I think he agrees with this predictability idea. I've tried to argue that we have historical evidence, long historical evidence, short historical evidence, but if you do look at this late 60s and 70s period, is very activist in the sense that Larry uses it. I would call it very interventionist, because you do want to have an active government. You want to respond. You want to have the automatic stabilizers. You want a monetary policy that responds, but in a predictable way. So we have so much evidence that this unpredictable, interventionist, sometimes pejoratively called Keynesian policies, led to double-digit inflation, double-digit unemployment, double-digit interest rates. And when we moved away from those, and we can quarrel with whether the data are correct that we moved away, which I think we did, things got much better. And so we have that evidence. And then we have the evidence now. Let's say things are not working well and we're intervening like mad. Now, one very important question that came up in this debate is Larry says, well, that's what you'd expect, a more activist government when times are bad. But I would say that that's not what the data show. The data show we started to intervene in the late 60s and 70s, and that caused the higher inflation, that caused the double-digit unemployment, that caused the low growth. Then we stopped, for the most part, stimulus packages. We got a monetary policy that was more predictable. That happened before the reduction in inflation. That happened before the reduction in unemployment. The result with those declines, that was clear evidence that the policy that change was causing it. Now, this most recent period is more difficult to determine, because there was a crisis and interventions occurred at the same time. But if you look at my chronology, the interventionisms began before the crisis. The Federal Reserve with its interest rates too low for too long. The failure of regulators to enforce the rules that they're supposed to enforce. The intervention into the process, that occurred before the crisis. Yes, we responded. But when the emergency was over, the panic, we still started to do all the panic stuff. QE1, QE2. So it seems to me that you can't make that reverse argument. You come back to the basic idea here that government interventionism, not government per se, government interventionism has been the problem. And to me, just to conclude, the good news here is it tells us where to go. It tells us to stop, to move to a steady-as-you-go monetary policy, to move to a tax system which doesn't change every year completely, to try to make it more stable, to move to a deficit policy that gets the deficit down, reduces the exploding of the debt. It's very clear what comes out of this, and I think if we do that, and I think there's agreement on a number of these issues, we'll be better off as a country. And that's the main message I would take away from this.
So I just have one comment. Wouldn't it be nice if the presidential debates this fall were carried out at this level?